Alright, we're going to look at the financial statements, and we talked about researching a stock as a business. And what we talked about in particular is financial condition. And the financial condition, the way that we find or evaluate the financial condition is through the financial. Alright, we're going to look at the financial statements, and we talked about researching a stock as a business. And what we talked about in particular is financial condition. And the financial condition, the way that we find or evaluate the financial condition is through the financial statements. And the three basic financial statements are the balance sheet, the profit and loss statement, and the cash flow statement. Alright, let's take a look at the balance sheet. The balance sheet is a statement of the company's assets, liabilities, and stockholders' equity. And it tells us about a company's liquidity, their solvency, and after you evaluate the liquidity and solvency, you can determine if it's a financially flexible company. And down here we talk about liquidity, solvency, and financial flexibility. Liquidity is a measure of how quickly assets can be converted to cash. Solvency is a measure of the ability to pay for a company to pay its debts as they become due. Financial flexibility is the ability of a company to react if unexpected or unforeseen circumstances were to occur that affect the business adversely. So in a nutshell, once you evaluate a balance sheet, it basically can tell you whether a company can survive with its cash reserves or its assets. If a weather catastrophe was to take place, they have a nasty legal lawsuit, or they have an extremely bad sales year, the company can survive with the assets that they have. The company assets. Assets is any resource or entity in which a company owns or controls that can potentially provide future economic benefits. You can also say that an asset is anything that a company can use to generate cash flow. And a couple of examples of company assets would be cash. It can be a plant or a factory, brand name, investments, patents. And a lot of people do not realize that a brand name is an asset. Believe it or not, a lot of strong brand names such as Nike, McDonald's, just their brands are so powerful that if you were to put, for instance, a Nike check on any type of merchandise, it pretty much will sell because that brand name, that brand is so powerful. Company asset categories. They can be divided in three categories. The three categories are current assets, fixed assets, and intangible assets. Current assets it includes cash or any asset that can be converted to cash within 1 year. And of course, current assets can include cash. It can include short-term investments, inventory, accounts receivable, and prepaid expenses. Fixed assets, on the other hand, are assets that cannot be converted into cash within 1 year. And fixed assets would be like land, raw land, properties. Maybe you own an apartment building or office building. It can be plants, or it can be heavy equipment, like maybe you're a construction company and you own a crane or bulldozers. These types of assets would most likely take over a year to convert or to sell to get cash for them. The other asset category is intangible assets, and what sets intangible assets apart from current and fixed assets is because these are something that is intangible. You can't touch it. It's nothing. It's not physical. And intangible assets include copyrights, patents, brand names, trade names, trademarks, and secret processes. And these assets are used to generate cash flow. Company liabilities. A company liability is any legal debt or obligation that arises during the course of business operations. And liabilities are settled through the transfer of assets, including cash, investment, properties. Liabilities can even be settled by the transfer of goods and services, and this is considered as trading. Examples of company liabilities include bank loans, accounts payable, salary payable, taxes payable, unearned revenue. And taxes payable, you can't escape the IRS. Salaries payable, if you have any employees, you're going to have to pretty much pay them. Bank loans, of course, that must be paid back. One interesting note is unearned revenue. Gift cards are a great example of this. People don't realize that when you purchase a gift card, a store gift card, that is not the company did not gain anything by you purchasing that gift card. They just incurred a liability. And let me explain that for a second. Basically, at a retail store, if a customer purchases a gift card in the amount of $50, the store receives $50 in cash, but they did not give up any asset, product, or inventory. And in turn, the customers, they purchase that gift card and they give to a friend or family member, and as a result, that store owes the friend or the person who received the gift card, they owe them $50 worth of merchandise. So basically, the store is in debt to the holder of the gift card until they use the gift card. So that's how a gift card is a liability as opposed to being an asset or actual sale. Liabilities are divided into two categories. Liabilities could either be current or long term. And basically, legal debts are legal obligations that are current liabilities. They must be settled within 1 year. Current liabilities will probably include salaries payable, unearned revenue, taxes payable. Those are legal debts or obligations that will be settled within 1 year. Long-term liabilities, on the other hand, do not need to be settled within 1 year, and they would usually include bond payments, lease obligations, and bank repayments or notes payable. So now we get to stockholders' equity. Stockholders' equity is the measure of the equity stake that an investor has in a company, and is calculated simply by subtracting the total assets minus the total liabilities. The example below has a plus sign. It's supposed to be a minus sign, so disregard that. Total assets minus total liabilities will give you stockholders' equity. Stockholders' equity is also considered as the book value or net worth of the company, and you can even look at this in a personal from a personal perspective. Take all of your assets. You may own a house. Take the value of your house. You may have a car. You may own stock. You may have a 401k. Add up all your assets, and then now take into account all of your liabilities. You have credit card debt. You may have a mortgage. You may have a car note. You may have all of these things that are considered liabilities. Once you subtract your assets from your liabilities, you will come up with your actual net worth. It's the same difference. With a company, it's just on a larger scale. So let's look at a couple of examples here. If Microsoft has $3 million in total assets and $2 million in total liabilities, then the stockholders' equity in Microsoft would be $1 million. Basically, I got that from subtracting $3 million minus $2 million. Let's look at another example. If GE had $40 million in total assets and they had $160 million in total liabilities, then the stockholders' equity would be a negative $120 million. That's not good. And just think about this for a second. Let me put this into perspective here. Let's say that Microsoft said that they were going to shut down operations, okay? They were going to just, we're going to go out of business. Well, if that was to happen, Microsoft can liquidate the entire company for $3 million and pay off all of its debt and have $1 million left over to pay to all of the stockholders, who are owners in the company. Whereas if GE shut down, they wouldn't be giving anything to the stockholders or owners of the company, because they have to pay off their debts before they can pay off any owners or stockholders within the company. So that's why that is not good to have a negative equity in a company. Alright, so let's look at the profit loss statement or income statement. The profit loss statement highlights company's sales revenues less expenses. Company's sales less its expenses equals its profit or loss. The income statement is basically a statement that measures the company's financial performance over a specific accounting period, usually quarterly or annually. The income statement is only based on revenues and expenses. The income statement is broken down into two components, like we just said, revenues and expenses. So let's take a look at this diagram here. We see that money or sales comes through the company, and now the expenses, whatever expenses that they have to pay out, it leaves the company. Okay, so once again, revenues come into the company, and then the expenses are coming out of the company. And the object is, I don't know if you've ever heard of this terminology, but a lot of people talk about it's not how much you make, it's how much you keep. Well, once again, the profit loss statement can be applied on a personal level. Your revenues or your paycheck that you receive every 2 weeks or every month, that's your revenue. And your bills that you pay, your light bill, your water bill, your gas bill, your car note, all of these are expenses that are leaving leaving you. Okay, and so your revenues minus your expenses will give you what your profit is for that particular year. Alright, so revenues are simply sales that a company made either by production or delivery of goods, rendering services, or by any other activities that define their business operations. And revenues is synonymous with sales, so a lot of people use that interchangeably. You'll hear people say that the company's revenue declined, or you hear them say their sales decline. The two terms mean the same thing, they're used interchangeably, so don't get confused when you hear that. Revenues can be divided into two categories. Revenues can be operating revenue or non-operating revenue. And operating revenue is basically sales generated through normal operations or everyday business. Non-operating revenue is money or assets acquired from, maybe you had to sell a business, or it was income from outside investments, or it's basically all revenue received not associated with normal business activity. So let's say, for instance, that I own a convenience store. Okay, that's a retail operation. Okay, so maybe I had a kitchen within my convenience store. Okay, and I was selling chicken in my convenience store as one of part of my normal operations in my convenience store. And I decided, okay, I no longer want to operate a kitchen in my store, so I decide that I want to sell my commercial stove, I want to sell my refrigeration equipment to somebody else. Well, the money that you receive from selling your stove and your refrigeration equipment will be considered as non-operating revenue, because you don't normally sell stoves as your normal day-to-day business. So that would be considered non-operating revenue. Expenses. Expenses are basically simply the cost that a company incurs during production and delivery of goods or rendering services. Anything that is used to do business operations will be considered an expense. An expense decreases assets, and it increases liabilities. Cost of goods sold. Expenses can be classified in basically three different categories. It can be cost of goods sold, selling expenses, administrative expenses. Cost of goods sold is basically all costs incurred to manufacture the products that are sold. If the company is a wholesaler or a retailer, then the cost of goods sold is the amount that the company paid for the merchandise to resell. That would be classified as cost of goods sold in that respect. And cost of goods sold, depending on what type of business it is, can be different. Selling expenses are basically all costs associated with getting the product sold to the end user. So that can be advertising, sales associate, your sales team, anything that you use to actually sell your merchandise will be considered selling expenses. And then we have administrative expenses, and these are all costs associated with the administration of your company, and that could be, include payroll clerks, supplies, insurance, your rent or lease. Anything that is used for administrative purposes is not used to actually sell your products. And companies will typically consolidate these expenses on the income statement. They will classify it as SGA expenses, or selling, general, and administrative expenses. And there is a special note. Cost of goods sold may be calculated differently depending on the business model. I mentioned that a little bit before. But it's usually all resources used, whether it's labor hours or materials used to produce a company's product or perform a service. So keep that in mind with cost of goods sold. In addition to that, expenses can be classified as operating expenses or non-operating expenses. And once again, operating expenses are expenses that are incurred from everyday business operations. Non-operating expenses are costs that are incurred to sell a business or an investment, or any expenses that are not associated with normal business activity. So say I mentioned before, we talked about a convenience store owner selling his kitchen equipment because he's no longer going to use the kitchen. All of the payroll dollars and maybe he had to ship it to the end user or ship it to the restaurant that decided to buy the business. All these would classify as non-operating expenses. Alright, and here are some profit and loss examples. Let's look at a company generates $300 million in sales revenue and has expenses totaling $250 million. Well, in this particular case, they would have a $50 million profit. Alright, a company generates $300 million in sales revenue and has expenses of $320 million. That will equal a $20 million loss. Right, now cash flow statement. This financial statement, it gives us a detailed view of all cash received and dispersed within a financial period. And the cash flow statement, it breaks down how cash was made and how it was used. And the key is this financial statement only deals with cash. It deals with only cash. So let me give you an example of that. Let's say, for instance, you were to purchase a car for $10,000 and you paid $10,000 cash for that car. Well, your bank account will actually see a decrease of $10,000 because you paid cash for that car. However, if you were to finance that car for $10,000 and you put no cash down, then you will see no change in your bank account, hence no change in your cash balance. So cash flow, once again, is dealing with only cash. And the cash flow statement is divided into three main sections. It's cash flows from operating activities, cash flow from investing activities, and cash flow from financing activities. And in the end, it shows a net increase or decrease in cash during a particular period, annually or quarterly. Cash flows from operating activities deals with sales or expenses associated with everyday operations, with primarily it includes the sales, general and administrative expenses. Cash flows from investing activities involve cash received or used to enhance operations or minimize operations. This can include purchase of a plant or factory, or it can include a sale of a plant or factory. It can involve the purchase of another company. Cash flows from financing activities involve cash flows provided by or used in financing or funding operations. And this can include issuing stock for cash or taking out a bank loan for cash.